Hey guys, you Fields here. Today we're going to be going over the portfolio for the week. The week started off somewhat okay, but then the last 2 or 3 days of the week really just decided to go bear. So you can see about half the market here is red, probably a little bit over half. So overall, you know, not too nice, but overall, it's kind of somewhat expected, right? There is a correction coming in sometime, and yeah. So moving on to the portfolio for the week, what we can see here is the S&P 500 went down about 1.63%, at least according to my spreadsheet. Our Composer portfolio went down 1.76%. Our M1 Finance went down 1.18%. Our Webull went down about 5%. And that totals for the total portfolio for 1.441. So we actually did a little bit better than S&P 500 this week in terms of kind of hedging our bets, I guess you want to call it. Which is pretty nice. But for the month of November, we're already down 1.41%, of course. So not super nice, but yeah, actually, I didn't think about that. So that would have included this would have been the first start date of the trading day, or first trading day of November would have been the 3rd, so that's why that's matching. But anyhow, moving on, I want to go through each of the individual portfolios. So first of all, despite that, obviously we're still pretty high. We're at 374, which is pretty nice. You can see I keep having to update this chart because the Webull stuff is just going crazy, which is a good thing. You can see in the last 30 days we're up 25%, so that's super nice. Obviously, we've been down quite a bit, but instead of negative 90%, we're down to negative 71, which is nice. I think the other day I saw negative 68. So we're getting there, one day at a time. Moving on to the M1 Finance portfolio. Take a look here at the week. Again, I don't know what this is about. I still really didn't investigate that. Didn't really have a lot of time this week. But if we take a look here at the top sectors, so you can see the top one for this week would have been healthcare, with the largest gain in Eli Lilly, 7%, which is pretty crazy. Then we have energy, the largest gain there from being ExxonMobil. And then last but not least, utilities, with the largest gain being from NextEra. Now, funny enough, they went down quite a bit last week because of earnings. And so did Southern Company, but it seems like they're still following that trend. So, in terms of what went down the most, semiconductors was on top for that. Largest being from AMD, 8.82. NVIDIA, 7. So, there was a lot of news here with like deals and stuff, to be honest, that the whole we're in an AI bubble thing. So that was the largest tank of our portfolio. If I go back there, you can see 7%. The next sector was only down 1% in comparison. So 1.7%. Largest loser there was Microsoft. And then last but not least, we have industrials. The largest loser there was Honeywell. Funny enough, I just set up my Honeywell thermostat this last week on my phone, which was kind of interesting. In terms of dividends, we did get a dividend this last week from MasterCard for 91 cents, so that's pretty nice. I need to remind myself to look into this. What is that? Oh, look at that. So that probably came from like a split, maybe, from Honeywell? Interesting. Again, I'll have to look into that because huh. If we go to the holdings, we're up 15% for the lifetime of our account, which is not too bad. Majority of that's obviously from March to today, from when we switched over from dividends. Um, what we can see here is AMD is on the top, Google, and then ABGO, and then NVIDIA, for example. Most of those companies are semiconductor companies, so hopefully our gains don't get wiped away anytime soon, but it is what it is. AMT, PG, and that Solus company are the worst losers, but again, this Solus company was just added to our account, so let's just ignore that for now, and we can just look at Costco. So 5, 7, 13, not really nice, but it is what it is. So alrighty, moving on to the Composer portfolio. So I did look into it. So first of all, let me pull up IC stats real quick. I did look into it, and the performance between the two was actually interesting. So first of all, it did so at the start of the week. It actually started at around a risk score of like 10 or something, and then it slowly has started going down, which is super nice. So I told myself last week that I'd probably consider just shifting into this portfolio, um, solely because it seems to, uh, what am I trying to say? It seems to do really well compared to our portfolio. So if I come over here and go to here and go to simulated, and let's just say, well, for example, this last week, right? Let's do uh let's do from whatever. This probably is fine. So that would have been all of last week. So from the 3rd basically to the 7th. So what was interesting here is according to the back test, we went down 0.2%, whereas our portfolio went down technically 2%. And then the SPY portfolio went down 1.6%. Now, what's interesting though, obviously, I was holding these for pretty much the entire length of time. So if I come over here and we can see here that this is down 0.4%, so they're not the same, and that's kind of what this little number here denotes. So that's the percentage difference between the two. Not the percentage difference, the raw percent difference, in the sense that it's not a like percent increase decrease, but it's the actual raw number, because these are percents, right? So we're up. This is 4.43, negative 0.43, and if we go at the same time period here, this is 0.15, right? So you do the math, and it's about 0.3. Now, to be fair, our portfolio here, the one that we're running now, is 0.7. But at the same time, this has had quite a bit of history behind it at this point. So it's kind of a difficult thing to like decide on, I guess. But anyhow, I'm still thinking about doing it, because if we go back to this, I guess, and we come over here, for example, in the last month, it has done pretty well. It's beat our portfolio by quite a lot. It's up 4.6%. 3 months, it's beating it by about 2%. 6 months, it's actually losing, but still pretty good, only losing by 1%. In year to date, for example, it's up at 40% versus 33. And then we'll just, I guess, do the year, which is at 42 versus 32. Now, obviously, this is aiming for around 62-ish percent. So, There was this other one that I saw. I don't know if I guess I started watching it on the 5th, so it would have been past the last video. Um, this one is interesting. So it goes all the way back to 2007 and has about 120% um, uh, CAGR, which is really intriguing, actually. It obviously has a higher drawdown, and the Sharp is actually lower. But what was really interesting is just the raw return you get. If you can kind of go for that bumpy ride, the standard deviation is probably also what's kind of carrying it down here. If we actually take a look here, though, let's see here. If I go to ICDB and look for this, and come over here and do quant stats report on it, what we can see here is, so if we go back up to that Sharp, so on this one it's showing 2.89, but on here the Sorrentino is actually 4.85 versus the other one, which is probably lower. But what I was intrigued about is while there is a case to be true about a couple, 3 years here are exceptionally high, especially 2020, a 600% return is insanity, right? So you have 673, and then you have these 2 years, which are about 350, and then you have, maybe you could count 2022, but also you could say the same thing about 2025. I mean, 2025. My point is the DV or the spread out. I guess the consistency of each month is seemingly like closer together than its extremes. Whereas if I go back to this portfolio here, um, and then do a quant stats report on that one, I'll show the Sorrentino on this as well. So the Sorrentino is 7766, which is higher, but you can see here that seemingly we have that same problem, obviously, where those 3 years are super high. And outside of that, though, if you take the average, that's what I'm kind of scared about, because this one's supposed to be averaging 62. I guess it maybe does. In fact, let me whip something together real quick. Okay, so if we take a look here, so I kind of put all of these the return series in there year by year. Now, this isn't the best way to do this, obviously, because it does really matter if you go on more granular time frames, such as monthly or even weekly or daily, for example. But we just look at year returns, and then we compute the means for each of those. So the top one here is the concise. Um, this range concise EM signals, and then this one here is the one that has that way higher return, right? So 2020 had a 600% return. So if you compute the mean between the two, so first of all, the first one's at 68, and then the second one is at 150, right? Which is pretty close to the 62-ish, and then this is 60 or 120. Now, if we take the 2008, 2009, and 2020 away from each of those, you can see that we lose about 20% there, and then we lose about 60% there. So don't get me wrong, the 100 or the 92% is still very high, but the problem that I have with these is that, or this one specifically, is it could potentially be so different, right? Like, what I'm trying to say is I'd also kind of want to run a test on this. So basically, maybe put $50 into this or $100 into this, and then run it, kind of like our deviation tests, which we usually use IC stats for example, to kind of get a sense of whether or not this is going to be even close. One thing to point out, though, that deviation is not really, it doesn't show anything about overfitness at all. all it is there for is whether or not the backtests match the live results going forward. But being overfit is a completely different question, in which case this could be very overfit. And most people would look at these and the fact that 2020, 2008, 2009 look that way are probably a big sign of overfitness, which I could see. But overall, I don't know. What I was also playing around with was the fact that we could basically take these two and actually combine them. So if I come over here and filter by this one, I can put these in my Maestro. And right now, these are equally weighted. So if I go into metrics, we can see so the range concise one. Remember, this is showing, and all of these different platforms have their own way of calculating numbers. So this might not show up exactly the same, but you can see the annualized expected annualized returns very similar. So we'll take a look at but yeah, just for brevity, we'll take a look at the annualized return column. So you can see range concise is at 65, the max drawdown is at 11, and the volatility is at 15, and the Sharpe ratio is obviously super high. But if we sacrifice a little bit of the risk volatility or the risk to return ratio kind of thing, you can see that we could get a 95% return with only adding a little bit more max drawdown. And yes, a little bit more volatility. And this is equal weight. If we were to do, if we were to do something like maybe 60-40, right? So 0.6, I think it's like something like that. 0.4, I think, do you have to do that? Yeah, you do. And if we compute these returns, we're going to get about a 90% return. The volatility doesn't really change. Like it went down 2, and the max drawdown. Did I do the right ones? Yeah, I did. So you can see that. I mean, obviously, we are getting a lot higher return. The Sharpe ratio is probably not ever going to beat Range Concise, just solely because it's just super high. If we look at the Sorrentino, that's also super high. I guess maybe the Calmar ratio. Yeah, the Calmar ratio we would see here is at 678. If we wanted to just look at returns to max drawdown, which is basically the Calmar ratio, that's what we would want to look at. So you can see here that this beats those two. And if we take away maybe the weighting and just go back to equal weight, I didn't actually see what it was at. We take away the weighting, we can see the Calmar ratio is 672. So very nice. And this is almost at 100%. So that's really cool. Again, there's a lot of questions that rise in the air. Obviously, is the FTLT with 2x, is that going to be overfit? Who knows? Who knows? So that's another reason. Like, so since OOS, it's not done well, but also neither has anything else. So first of all, this is a lot more volatile than anything. But if I pull that up in actual Composer, I think I have this compared to R2 things that we're looking at here. If we go for example, the last month, you can see here that it actually does beat these by a long shot. So it's twice of that of Rain's portfolio and a lot higher than the current portfolio I'm running right now. If we go back, if we just do the last week, for example, yeah, let's just do like there. The opposite is true, right? We're down 7%. But that's just how volatility goes, where we can be up 50% now, and in a week we can be down 50%, right? Not exactly, but realistically speaking, that's how it goes. And you can see that in just the raw number standard deviation column here. the one that has literally the lowest standard deviation has the lowest cumulative return. Or sorry, the most neutral, like the highest actually, is what I was trying to say. It's not always the case. Obviously, you can see here. You can look at the Sharpe ratio, for example. That's probably a better measure. I guess it technically uses the cumulative return, so it's not a fair comparison. But anyhow, my whole point is I'm still doing a little bit more research. I think I'm gonna try to purchase a little bit more of this. I am coming up on putting in more money in the portfolio, which is nice. So this time around, I think I'm going to do about 1,500 in each, the M1 Finance and then Composer. So that's nice. And last but not least, before I head out, um, reminder, and this is also in the description, to use the trading pass when you sign up. It gives you 25% and gives me 25% off from the trading pass. And also, I don't know if I've mentioned it before, I really need to, but on the 16th, this will go away. Let me um, let me show you guys what I'm talking about. There's a really good deal right now. I think it's going away on the 16th. So basically, if you buy a year subscription, it comes out to 48 bucks a year. If you buy a monthly subscription, it comes out to $5 a month. Obviously, this will only last for your next month. I went ahead and I converted my thing to a year subscription because I mean, that's basically how much I was paying for one entire month before. So if you guys are new to Composer, this is a great time to get in, even just with that monthly pass. Or if you guys are existing members, like I said, you can basically cancel your pass and convert it. If you have any problems, the support team's pretty good at this stuff. So reach out to them there. But anyways, guys, that is it from me. And as always, I wish you guys a well-to future.